I've been knocking on the door and saying, look, your analyst is saying gold's going to 4,300. What have I got? You've just got me the wrong bloody stuff. And this will be acute when that credit bubble pops. Because I tell you what, it's going to be a very nasty scene in industrial equities, in stocks and all the rest of it. And I don't know how much people will be able to.
But I am suggesting that the increase of the gold price, the nominal gold price, may likely mirror the decline in purchasing power of the US dollar. If that's true, the nominal gold price would increase 3 or 4-fold in the ensuing 10 years. If that happens, a reasonable allocation to gold can hedge a lot of the portfolio deterioration that you would experience in other parts of the portfolio. I want to say, too,
while mainstream financial media celebrates the S&P 500's continued march higher, a crisis is unfolding in slow motion. The Congressional Budget Office, not some doomsday blogger, but the official government watchdog, just confirmed that America's unfunded obligations now exceed $120 trillion. To put that in perspective, the entire federal government collects just $5 trillion per year in revenue. Rick Rule, legendary resource investor and former CEO of Sprott Global and Alasdair Macleod, who's been warning central banks and pension funds about what's coming. What they're about to reveal will shock you. Pension will likely become insolvent, bonds may very likely guarantee losses. And the playbook that worked for 40 years just became obsolete in 2022. But there's a way out, and Harvard University, Morgan Stanley, and the world's smartest money are already making the move. The question is, will you make the move to be informed before it's too late? Let's dive in. Let me start with something that should terrify every financial advisor in America. Rick Rule laid out the stark reality. I believe the period 1982 to 2022 was perhaps the most benign economic climate in human history. Think about what he's saying. Everything you know about investing, buy the dip, diversify into bonds, trust the 60-40 portfolio, was built during the greatest bull market in history. Baby boomers coming of age, falling interest rates for 40 years straight, US dollar hegemony ensuring global stability. That era ended in 2022. Rule continued, I think people are continuing to invest as though that set of circumstances were true. That's really the challenge. Here's the mathematical death trap facing retirees right now. The government tells you inflation is running at 2.9% annually. They call it the CPI. Rule calls it the CPI lie. When you factor in what real people actually pay groceries, energy, healthcare, and especially taxes, which the CPI conveniently excludes, inflation is running at approximately 8% per year. And it gets worse. Those pension funds and insurance companies that bought long-duration bonds in the 2010s and early 2020s, they're sitting on massive unrealized losses from the rate shock of 2022 to 2023. If they sell, they lock in devastating principal losses. If they hold, they guarantee they can't meet future obligations. Alasdair Macleod described it perfectly. Anyone looking at a pension fund is actually looking at a loser. Now we'll show you more clips of the latest interview. But first smash the subscribe button and turn on notifications so you do not miss out on our daily recaps.
I'll do my best to give a brief response. I believe the period 1982 to 2022 was perhaps the most benign economic climate in human history. The baby boomers were coming of age. So you had that wonderful demographic boom, great labor force participation around the world, increasing amounts of free trade. Wonderful, wonderful, wonderful time. Falling real interest rates, US dollar hegemony, so financial stability. I think about 2022, that epoch came to an end. And I think people are continuing to invest as though that set of circumstances were true. That's really the challenge. I don't think that you're going to see falling long-term real interest rates again for a long time, despite government's attempts to manipulate them. I don't think that you're going to have the demographic advantage that you had with the baby boomers, although I do think that rising emerging and frontier markets economies will help temper that. But I also think that you're going to have falling real yields. And by that, I mean that the yields offered up around the world on savings products are likely insufficient to cover the deterioration in purchasing power from various currencies. Most importantly, of course, being the US dollar. I say most importantly, not merely because I'm American, but because the U.S. economy generates 23% of the world's savings and investments. It is, for better or for worse, still the world's reserve currency. If you believe the CPI, the government statistic, I refer to it as the CPI, you believe that the deterioration of the U.S. dollar is proceeding along at about 2.9% a year compounded. Not good, but not bad. If you look at the basket of goods and services that real people consume, including prominently tax, the CPI doesn't include tax, which makes it a silly measure of the cost of living. I believe that the deterioration of the U.S. dollar's going along at about 8% a year. So you can see the problem arithmetically. If you're saving at 4.5% and you're spending in a currency that's depreciating at 8%, buying what is allegedly the safest savings instrument in the world, the U.S. 10-year Treasury, guarantees you a 3.5% compound loss. And that's the real challenge facing asset managers. The old long bond portfolio for university endowments and insurance funds guarantees that you won't have enough money to satisfy your obligations 20 or 30 years out. Fairly stark reality.
Broadly, I think what Rick says is absolutely right. I mean, anyone looking at a pension fund is actually on a loss, or a loser. The only thing you can really do now is protect yourself against the declining purchasing power of currencies. And the only way in which you can do that is to buy physical gold. I mean, I would prefer ownership of gold rather than indirect credit through an ETF. And the other thing, I think, is to look at maybe some other commodities. Because the one thing that's happening, which we just don't understand in the West, is that there's a whole world out there being run by, dare I say, China and Russia, are small enemies, but they basically are assembling the majority of the world's population, and they're going to industrialize it. And that's going to require an awful lot of base metals. It's going to require also gold and silver for monetary purposes. And so that's the area where you've got to look. And we haven't had any sort of move out of conventional investments into these defensive sectors. And that, I think, is going to be an interesting challenge, particularly when you understand that equity markets are basically being sustained by a credit bubble. I mean, just look at what's been going on with the leverage, if you like, the debt leverage through loans, to investors who have been leveraging up in order to improve their returns on presumably on the Magnificent Seven or whatever. They're so greedy. I mean, the latest figures from FINRA looks. I mean, you're looking at over $1 trillion outstanding there. Now that's got to be unwound, and it will. I mean, it's a sign, if you like. It's the clearest sign that this is a credit bubble. And if you look at the behavior of investors, I mean, they're just chasing momentum. Who gives a damn about value? That's not the way to go. So it reminds me so much of the dot-com bubble back in 2000. So all the symptoms are there, the psychology and everything else. And then on top of that, we've got President Trump's beautiful tariffs. And I tell you, this just reminds me of 1929 when we had, the Roaring Twenties, which was the puffing up of credit, the credit bubble. And then you had the collapse from a high point, I think in September 29. The market lost 90%. And guess what? We had tariffs as well, Smoot-Hawley Tariff Act. That came in. The whole situation is so reminiscent of that. But this is far larger. This is a dangerous time. But at some stage, investment managers are going to realize they're doing completely the wrong thing. And I think it's just beginning. For example, you see major banks like Goldman Sachs, Bank of America, Citicorp, whatever, now saying gold's going to go 4,000 or 4,300, whatever they say. But think about their poor clients. They haven't got any. I've been knocking on the door and saying, look, your analyst is saying gold's going to 4,300. What have I got? You've just got me the wrong bloody stuff. And this will be acute when that credit bubble pops. Because I tell you what, it's going to be a very nasty scene in industrial equities, in tech stocks and all the rest of it. And I don't know how much people will be able to get out. But at the moment, on average, if you look across the roughly 300 trillion of investable assets, less than 0.5% of that is in gold. They've got it completely wrong-footed. So I really think that the next few months, and I think it's that soon, the next few months are going to be extremely interesting from the point of view of the switch, if you like, away from, the current winners, which will become suddenly, like cyanide to investors, into obviously what's already running, and they just haven't bought it. So fascinates me that, look, I'm a fairly simple soul. I just say, get the hell out of credit, just get into gold or silver.
Personal financial planning over time is a very long-term endeavor, but the arithmetic around it is fairly simple. The second thing is that talking to either Alasdair or myself about retirement is fairly foolhardy. Both of us have failed completely. It's important to note that when Social Security was instituted in the United States, its mandate was to provide basically poverty-style existence for people above the age 65. And the median life expectancy of an American male when Social Security was instituted was 66 years. Demographics has changed. And so it makes perfect sense that people would need to prepare to live longer. I don't recommend retirement myself. I enjoy working. Let's just say that my mind needs to be either stimulated or sedated. Working for me is much healthier than drinking. And the consequence of that is that I like to work. On a more serious note, I think that if you look at the solvency of various retirement systems, including Social Security, that you come to the conclusion that you need to take care of your own retirement. If you are American, you need to bear in mind that according to the Congressional Budget Office, the net present value of unfunded entitlement obligations in the United States exceeds now $120 trillion. This number doesn't come from a balding, fat, cranky old libertarian. It comes from the Congressional Budget Office. Now, to put that in perspective, gross federal income is $5 trillion a year. What do you think the probability is that the United States, and Alasdair will have to give the European or British numbers, but what do you think the probability is that the U.S. government, with $5 trillion in gross income, and of course a government and a nation to run, can honor $37 trillion in on-balance sheet liabilities and $120 trillion in off-balance sheet liabilities? Think about the arithmetic around this, and think about despite the fact that you paid into Social Security for 40 years, which is irrelevant, there isn't enough money to take out. Think too about some other form of retirement entity, perhaps private, that invested the bulk of their proceeds in 20 or 30 year debt obligations, yielding some number like 4, 4.5, or 5. Where the underlying inflation rate is 8. The managers are in for a tough spell. If they sell those low-yielding instruments, they take hits to principal down. If they hold them, they guarantee the fact that they can't fund their obligations over time. Talk about a rock and a hard place. So understand where you are, understand who you are, and plan accordingly. It's your only chance.
Both Rule and Macleod are old enough to have lived through the last time this happened, the 1970s. Rule revealed. The Congressional Budget Office says that in the period 1970 to 1980, the purchasing power of the US dollar declined by 75%. 75%. In one decade. That's how America solved its last debt crisis, by devaluing the currency and effectively defaulting on obligations through inflation. Both experts believe we're heading into a similar environment, but this time it's bigger, much bigger. In the 1970s, as the dollar lost 75% of its value, gold ran up 30-fold. 30 times. Rule isn't predicting that exact return because gold has already risen 13-fold since 2000. But he is suggesting that if the dollar loses 75% of its purchasing power again, we could see gold rise 3 to 4-fold from current levels in the next decade. Meanwhile, institutional money is moving quietly. Last month, the Harvard University's Endowment Fund, one of the most sophisticated investment operations in the world, announced they're putting approximately 7% of their portfolio into gold. Also, Morgan Stanley made a historic announcement. Mike Wilson, their chief investment officer, said they're abandoning the traditional 60-40 portfolio. Instead, they're recommending 60-20-20, 60% equities, 20% bonds, and 20% gold. Now we'll show you more clips of the latest interview, but first smash the subscribe button and turn on notifications so you do not miss out on our daily recaps.
One thing you said in that little bit was that there's a bit more volatility and all the rest. I tell you, pension fund managers do not want volatility. They want certainty as much as possible. So volatility is not the way to go. It really isn't. And if they're going to be looking at things like Bitcoin and so on and so forth, I mean, that's the end of life as far as they're concerned. I mean, the situation that Rick described is exactly the same in Europe, but we've got other things on top which make it even worse. First of all, we've got something called defined benefit pension schemes. Now, these basically will pay a guaranteed 2/3 of salary, inflation-linked, etc., etc. But guess who's got them? Bureaucrats, civil servants. Nobody else has got them. So in other words, the cost of this is just escalating. And as to Rick's point about inflation, I mean, not only is it running at a far higher level than CPI statistics would have us believe, but on top of that, my forecasts are that we're going to get far higher inflation in the next 2 years. The reason I say that is if you look at what's happening, gold is signaling, if you like, it is anticipating a collapse in the purchasing power of fiat currencies. I reckon this is the end of the fiat currency era, which started in 1971. Now, under those circumstances, you're going to see prices rising, not because they're rising, they'll actually be falling in real terms, but because the currencies are falling even more rapidly. This is playing havoc with any pension fund manager's arithmetic. I mean, it really is. And then on top of that, of course, over the last, 50, 60 years, pension fund managers have been encouraged to diversify out of bonds and into equities. So when you get an equity market bubble going pop, this is going to again cause huge damage. And further on that, of course, was the sort of baby boomer population, which Rick and I are honourable members. We're all drawing pensions now, and the numbers have increased quite substantially. I mean, it's just everything in this arithmetic has just gone wrong. And you cannot rely on a pension to keep you in your old age. I mean, I know so many people who've been in government, for example. They got these lovely pensions. I reckon that at the end of the day, they're probably worth nothing. So, you're going to actually start thinking for yourself in this one and take some action to try and protect yourself. Sign up for account with Rick, or go and deposit some gold somewhere outside the banking system. That's obviously going to be the answer. The rest of it is just hot air. I
just think it's self-defense for the institutions. If you believe, as I believe, that in this sense, past its prologue, that the US dollar will lose 75% of its purchasing power over the next 10 years, like it did back in the 1970s, and I believe that. I think it's reasonable to suppose that the nominal price of gold, when I say nominal, I mean US dollar price of gold, will increase in a way that mirrors that. In the decade of the 70s, the last time the US dollar lost 75% of its purchasing power, the gold price ran 30-fold. Now, I'm not suggesting that over the next 10 years, the price of gold runs 30-fold, because as an example, since the year 2000, it's already risen 13-fold. But I am suggesting that the increase of the gold price, the nominal gold price, may likely mirror the decline in purchasing power of the US dollar. If that's true, the nominal gold price would increase 3 or 4-fold in the ensuing 10 years. If that happens, a reasonable allocation to gold can hedge a lot of the portfolio deterioration that you would experience in other parts of the portfolio. I want to say, too, that this isn't the only way up the mountain. I personally save in gold, but I maintain liquidity in US dollars. There's a very, very, very big difference between saving and maintaining liquidity. I don't own gold because I think it might go up. I own gold because there's been a golden constant. If you save in gold, if you look at home prices, or if you look at grocery prices, or you look at anything in your budget, save tax, you're surprised at how cheap things are measured in gold in the period 2000 to 2025. I think, too, that it's possible to over-allocate to gold. I know that'll be travesty in this call, but I note in the decade of the 70s, in the middle of an equities bear market from 1968 to 1982, a 14-year-long bear market that both Alasdair and I were part of, the Warren Buffett, who believed that gold was a pet rock, generated 24 or 25% compound internal rates of return over time. I would suggest to you that gold is merely a component, albeit a major component, of the strategy that will get you through the next 10 years. Alasdair mentioned earlier that on a global basis, allocation to gold relative to other savings and investment asset classes, according to JP Morgan Chase, is about 0.5%, despite the blandishments of the Harvard endowment. The 4-decade mean market share is 2%. If ownership reverted to mean, at least in the U.S. market, that would result in a 4-fold increase in demand for precious metals and precious metals-related securities. I'm not smart enough to tell you what that would do to the price, but I think it would be interesting. Again, I had a phone call with a former client a couple days ago who is now 100% in gold. This is daft. This is truly daft.
We are living through a paradigm shift. The 40-year bull market in bonds is over. The fiat currency era that began in 1971 may be ending. And for the first time in modern history, major Wall Street firms are telling clients to put 20% in gold. But ask yourself, if Harvard's endowment managers, Morgan Stanley's strategists, and investors who have successfully navigated 50 years of market cycles are all saying the same thing, shouldn't you at least investigate? Post in the comment section down below your honest opinion, share this video with someone who needs to hear this warning, subscribe and hit the notification bell to get future updates. Thank you.